Good morning, everyone. Welcome to our OakBridge Weekly Market Update. Today is October 17th, 2022, and we're happy to have you on board with us today. We're going to jump right in. One of the things that we're going to be talking about primarily today is the inflation report with the Fed and rising interest rates. Those are probably the two biggest things that are on the minds of investors right now is what's going to happen with the Fed and how is inflation and when is it going to be resolved or come down. And what we noticed is in September, the CPI report came in quite a bit hotter than expected. And just a number of upside surprises in the September report, and we had hoped for a little bit of deceleration in inflation. That didn't happen. There were some good things that happened. Core goods came down, energy prices came down, but core inflation itself jumped 0.6% month over month and 6.6% year over year. Most of that is coming from the services sector. Wage and inflation, resilient demand, just continue to bump up the inflation numbers. And we just, at this point, we're seeing that the Fed more than likely will continue to raise the interest rates with the aggressiveness that they've been talking about. However, with this chart, I want to show you some good things that are happening and just kind of talk a little bit behind the scenes for just a minute. What you can see here in this chart is this is retail inventories. During COVID, inventories were very, very low. We had supply chain issues. It was hard to get a lot of things. Cars, for example, not very many cars on the lots, and used cars are still up high with regards to inventory. And retail sales were continuing to climb, even though the inventories were less, which contributed greatly to the inflation that we saw over the last year. And what we're seeing right now is these retail inventories have come back substantially, which is the blue line. You can see that we've gone from a low of in the last year of about 525,000 in inventories, and again these are in millions, up to 725,000. Whereas if you look at the black line for retail sales for the last since 2021, you can see that we've kind of flatlined as far as our purchases have concerned. And so what we're seeing here with this is because the supply chain issues finally are starting to heal a little bit, inventories have started to rebound. They're above what they were pre-COVID. We expect this to be a significant factor in reducing inflation in the future, even though that we don't see anything happening right now. So here's kind of what we expect going forward. We still expect the Fed to raise interest rates by 0.75% next month, followed by another 0.5% in December. After that, we kind of expect the Fed to shift to smaller hikes and then maybe a pause, maybe not too far out. And so we're seeing some good things. They're just not quite here yet, but the market likes to see good things. And typically, as the market goes forward, it typically looks 6 months in advance rather than looking at what the data is today. And so anytime that we see a little bit of some good news like this, you'll see a little bit of a bump in the prices of the stocks. I'm going to break tradition here and talk and give another slide here. And this is kind of the price of stocks and what the price of stocks is today versus the price of stocks back in 2022 or 2021, excuse me. And you can see that at the beginning of 2021, we were clear up here at around 22 times earnings for the multiple. We are now down around 15.15. You can see the average is 16.84. So right now, the price that we're paying for stocks based upon the earnings, which is typically what the measuring stick is for how expensive or how cheap a stock is to buy. Right now, we're about 10% below the average cost per stock for the individual S&P 500. So that's good news as well. So we've got some room to run. We've got some room for the markets to get some gains. We just now need a little bit of cooperation from the inflationary scenario. So that's it for today. Thank you so much for tuning in. And again, please feel free to forward this link to any friends or family or coworkers that you think might be interested. And thank you so much for tuning in. We very much appreciate it.